Distinguished observers, this is your financial investigator speaking. To comprehend the chronology of the approaching international confrontation, you must cease monitoring aircraft carrier movements across the Taiwan waters. Naval deployments mislead observers. These vessels may execute training operations, demonstrate political messaging, or return to harbors within mere days. They represent the visible spectacle of international relations designed for public consumption. To discern a superpower's genuine intentions, to determine their authentic preparation for an irreversible separation, you must examine sovereign debt movements. Government bonds form the foundation of international order. They possess substantial weight and move slowly. Liquidating major positions requires months, occasionally years, without devastating markets. When the world's second-largest economy initiates rapid disposal of its primary adversary's debt at velocities that contradict economic reasoning, this transcends portfolio adjustment. They are preparing for warfare. Recent Treasury Department data demands meticulous forensic examination. The Treasury International Capital report represents finance's most tedious yet crucial documentation. Mainstream journalists examine superficial headlines while we scrutinize detailed footnotes. This intelligence confirms patterns Wall Street has attempted to ignore, downplay, or reframe throughout 12 months. China's documented Treasury bond ownership collapsed to $688 billion by October 2025. For newcomers, $688 billion appears substantial, and indeed it represents enormous wealth. However, within US-China financial relations, this figure signifies catastrophic deterioration. These holdings reached their lowest point since May 2009, effectively erasing 16 years of economic integration. For perspective, during 2013's peak of Chimerica, the symbiotic economic partnership between China and America, Beijing controlled $1.32 trillion in American debt. They essentially financed US deficits, purchasing bonds that enabled Americans to acquire inexpensive Chinese merchandise. This created a closed capital circulation system maintaining low interest rates and global commerce momentum. That system has shattered. China liquidated nearly 48% of their peak position, disposing of over $600 billion worth of American IOUs. Yet the total amount isn't solely alarming. The market timing of recent sales proves equally concerning. Throughout late 2024 and 2025, US bond markets experienced historic downturns. Interest rates fluctuated wildly while bond prices, moving opposite to yields, remained suppressed. Anyone disposing of Treasury securities during this specific period realized significant losses. In asset management, depreciated assets aren't sold at losses unless facing liquidity emergencies requiring immediate cash for obligations, or believing assets will become worthless. China doesn't confront liquidity crises. Despite domestic real estate challenges, they maintain massive global trade surpluses, possessing abundant cash reserves. This represents the sanction avoidance indicator. We must analyze through February 2022 lens when Russia invaded Ukraine. The United States and European Union executed financial operations that profoundly shocked Beijing. Overnight, they immobilized $300 billion of Russian central bank foreign exchange reserves. The implications of China's unprecedented liquidation extend far beyond simple portfolio rebalancing. Financial institutions worldwide are scrambling to understand the velocity and scale of this divestment. Traditional economic models cannot adequately explain why any rational actor would dispose of such massive positions during unfavorable market conditions unless driven by extraordinary circumstances. This liquidation timeline coincides suspiciously with escalating tensions across multiple geopolitical flashpoints. Taiwan's strategic importance continues growing as semiconductor manufacturing becomes increasingly crucial for global supply chains. Meanwhile, South China Sea territorial disputes intensify, with multiple incidents involving naval vessels from various nations occurring monthly. Beijing's financial strategists have clearly concluded that maintaining substantial exposure to American debt instruments presents unacceptable risks. They've witnessed how quickly Western financial infrastructure can weaponize foreign holdings during conflicts. The Russian precedent established dangerous new precedents for financial warfare that transcend traditional military confrontations. Chinese economic planners recognize that integrated global financial systems, once considered mutually beneficial, now represent potential vulnerabilities during geopolitical crises. Dependencies that previously ensured stability through economic interconnectedness have transformed into leverage points for adversaries. Therefore, the sole logical conclusion fitting available data, the Chinese Communist Party strategically determined U.S. Treasury bonds no longer represent reliable value storage. They perceive them as strategic vulnerabilities instead. This represents the sanction avoidance indicator. We must analyze through February 2022 lens when Russia invaded Ukraine. The United States and European Union executed financial operations that profoundly shocked Beijing. Overnight, they immobilized $300 billion of Russian central bank foreign exchange reserves. These funds resided in Western accounts across New York, London, and Brussels. Moscow considered this money secure. It wasn't. Several keystrokes seized or paralyzed these assets. Beijing observed, analyzed, and recognized a frightening reality. Should they advance on Taiwan or escalate South China Sea tensions, their treasury holdings wouldn't represent assets. They'd become hostages. The remaining $688 billion essentially constitutes a future donation to the U.S. Department of Justice. Once sanctions activate, that money disappears completely. Consequently, they are withdrawing. They are liquidating positions with extreme determination, accepting 10% or 20% haircuts on bond face values today, rather than risking total losses tomorrow. This represents strategic liquidation, the financial equivalent of scorched earth tactics. They are dismantling the debt infrastructure that stabilized America's economy for 2 decades with obvious urgency. Typically, central banks conceal selling to avoid market panic, disposing slowly in small portions. However, the recent velocity, shedding nearly $12 billion in October alone, suggests Beijing prioritizes capital flight over market stability. They want money beyond U.S. jurisdiction immediately. This profoundly impacts America's economy. For 20 years, the U.S. government sustained massive deficits because reliable Eastern buyers existed. China purchased debt regardless of yields, needing to recycle trade surpluses. That buyer vanished. China transformed from largest purchaser to largest seller, creating massive supply-demand imbalances in bond markets. Who purchases China's dumped debt? Who finances U.S. deficits now? The burden falls upon allies, specifically Britain and Europe, forced to cannibalize their economies to maintain America's financial system stability. When the second-largest sovereign debt holder dumps hundreds of billions onto open markets, basic economics dictates price crashes. Increased supply with vanishing demand reduces prices. In bonds, falling prices skyrocket interest rates and yields. If market forces operated naturally, China's exit should have pushed 10-year Treasury yields significantly higher, catastrophically impacting the U.S. economy by exploding mortgage rates, bankrupting regional banks, and making national debt interest payments unsustainable. Curiously, this hasn't occurred yet. Rates rose moderately, but markets haven't collapsed. Why? Because as China exits, allies must intervene. Examining Treasury International Capital data reveals, while China's holdings plummet toward $600 billion, other categories spike to historically abnormal levels, specifically Britain and Belgium. Britain's holdings surged to record highs, reaching over $750 billion in late 2025, positioning the UK alongside China as America's second-largest foreign creditor after Japan. Consider this. Britain's economy measures roughly 1/6 of China's size. Britain doesn't generate massive trade surpluses, they actually run trade deficits. Where does Britain acquire money for nearly $750 billion in US debt purchases? They're not buying with excess profits like China did during the 2000s. They're likely purchasing with borrowed money or through London financial engineering. The United Kingdom effectively leverages its entire balance sheet to function as a shock absorber for American treasury markets. This represents an unprecedented commitment that strains British fiscal capacity while providing temporary stability for dollar-denominated assets. European allies face similar pressures to maintain global financial equilibrium. The coordinated nature of these purchases suggests high-level diplomatic negotiations occurred behind closed doors, with Washington likely offering various incentives or applying subtle coercion to ensure allied participation in this unprecedented financial backstopping operation. This arrangement creates profound structural weaknesses within the Western financial architecture. Allied nations are essentially subsidizing American fiscal irresponsibility while compromising their own economic sovereignty. The long-term sustainability of such arrangements remains questionable, particularly as domestic political pressures mount within these allied nations. Furthermore, this financial conscription establishes dangerous precedents for international relations. Economic sovereignty becomes subordinate to alliance obligations, fundamentally altering the balance of power within Western institutions. Nations find themselves compelled to make economically irrational decisions to preserve broader strategic relationships. The velocity and scale of required intervention highlight the magnitude of China's financial withdrawal. Without immediate Allied absorption, Treasury markets would have experienced catastrophic disruptions with global ramifications extending far beyond American borders. Chinese strategists undoubtedly anticipated these Western responses, potentially viewing Allied financial strain as additional strategic advantages. By forcing allies to overextend themselves financially, China weakens the entire Western coalition, while strengthening their own position through commodity accumulation and resource stockpiling. Belgium demonstrates similar patterns. Recent data shows Belgian holdings around $370 billion. Has Belgian government suddenly acquired enormous cash reserves? Absolutely not. Belgium houses Euroclear, among the world's largest international central securities depositories. When Belgium appears purchasing American debt in Treasury reports, it's rarely the Belgian government, usually proxies representing other central banks, sovereign wealth funds, or custodial accounts seeking anonymity. The surge in Belgium and UK holdings, precisely as China sells, suggests coordinated G7 effort. This represents the burden-sharing alliance. This isn't free market activity. Why would rational London or Brussels investors aggressively purchase Treasury securities now? America runs $2 trillion deficits with persistent inflation and weaponized currency. Buying American debt currently represents risky trading. Allied accumulation suggests geopolitical arm twisting. Washington essentially declares China's dumping. Without your absorption of this supply, American bond markets collapse. If American markets collapse, global financial systems fail, and we can't protect you. This constitutes financial conscription. The West cannibalizes its balance sheets to absorb Beijing's supply. However, this strategy contains fatal flaws, capacity limitations. China possessed seemingly infinite purchasing ability because they were the world's manufacturing center, earning real dollars through real goods sales. Britain and Europe lack this capacity, already struggling with debt burdens, slow growth, and energy transitions. Forcing Treasury purchases drains Allied liquidity, weakening periphery economies to preserve the core. China recognizes this. They're executing attrition warfare, bleeding the West financially. Every billion in dumped bonds forces Western systems to find billion-dollar liquidity for absorption, drawing capital from productive investments like factories or infrastructure into American debt refinancing black holes. While Western nations shuffle paper liabilities among themselves, China converts proceeds into physical assets beyond Treasury Department reach. When China sells Treasury bonds, transactions settle in dollars with the People's Bank receiving digital credits in custodial accounts. But China doesn't want dollars. They're liabilities, traceable, sanctionable, and inflation-prone. They're engaging in history's most aggressive commodity accumulation campaign, converting paper claims into physical reality. Chinese state-owned enterprises swallow record raw material quantities. This isn't commercial inventory building, it's strategic hoarding. First, the golden transition. The People's Bank maintains relentless gold purchasing for 18-plus consecutive months officially, with shadow market withdrawals suggesting much larger buying. They're using bond sale dollars to purchase metals in London and Swiss markets, shipping eastward. Gold represents the ultimate anti-dollar with zero counterparty risk, immune to swift system freezing. Second, energy stockpiling. China imports 70% of its oil, their strategic vulnerability. During conflicts, American naval forces could blockade the Strait of Malacca, starving China's economy of energy. Countermeasures include record oil purchases from sanctioned nations like Iran and Russia, bypassing dollars entirely while filling strategic petroleum reserves to capacity. Data indicates Chinese crude stockpiles approaching 1.5 billion barrels capacity with satellite imagery revealing massive new storage construction. Third, strategic mineral accumulation. Despite depressed property sectors historically consuming copper, China's ore and concentrate imports remain near all-time highs at roughly 28 million tons in 2024. This defies logic unless transitioning to war economics, requiring copper for green energy grids, munitions, drones, and electric vehicles. They're cornering 21st century military industrial inputs while hoarding cobalt, lithium, and rare earths. For investors, the conclusion remains clear. Treasury bonds have become battlefields. The 60-40 portfolio era ends. Bonds no longer represent safe havens but political footballs in global economic warfare.